NBFI industry, we don't have a lot of public ratings, right?
That till date has left us with zero defaults and zero delinquencies.
And all these classic financial ratios, and we go an extra mile. So our secret sauce.
Hey everybody, and welcome back to Kilde Talks Finance. My name is Johanna, and today we are here with Gustavo, who is heading out Kilde's origination and underwriting. And you played a very key role, or maybe I should even say you're one of the key brains behind Kilde's underwriting and risk scoring methodology that till date has left us with zero defaults and zero delinquencies. So you're the right man for this conversation, that's for sure. And the topic that we wanted to cover today is in an industry that we operate in. So private credit with these NBFI borrowers that don't have official ratings, how do we ensure credit quality? And what does our internal model look like in broad terms for us to be able to give them any sort of rating or score?
Well, first of all, Johanna, thanks for having me here, for the kind words. It's a quite fair question, and to be honest, for us to address it, we develop our own internal capability, right, which is expressed by a Kilde Score. So the main reason why we decided to follow this approach is because the NBFI industry, we don't have a lot of public ratings, right? So a way of doing it is to combine our internal expertise, our understanding about the industry, and develop our own capabilities. So it always starts in a fundamental financial analysis of the borrower, and then we go deep into their loan book. So during this DD process, we can access the robustness of their balance sheet, understand the profitability of their product. We check the cash flow capacity of those borrowers to serve the debt, and of course, all into understanding of the macroeconomic and regulatory context of each country they operate, right?
It's quite comprehensive. And is there a framework that you could share, or maybe just some of the different steps that you look at? Or maybe we can take an example even. When a borrower knocks on our door, how do you start assessing them?
Fair point, and this is a question that I hear a lot. So in a sense, size matters. So we like to operate with borrowers that have some past history, they have some track record, they have a strong risk management team, and they already reach a sizable loan book, or at least they are on a growth path. And then, as I mentioned before, we started doing a fundamental analysis of their financial statements. So a standard practice of the industry, we get their latest audit reports, we check the level of profitability of their business, we check the level of leverage, liquidity, and all these classic financial ratios. And we go an extra mile. So our secret sauce, if I may say like this, is to go deep into the loan book. So the loan book analysis is basically delving into their loan tape, which is having access on an anonymous ways, of course, of all their underlying loans. And we can do with just a few minutes, we can digest all those thousands and thousands and thousands of lines into a very comprehensive dashboard that we can use to independently check the results in the financial statements. I always explain to the public that NBFI can move from being a cash call to an unprofitable business just because, let's say, provisions is not well set, right? So when we do this kind of two-side approach of checking their loan books, their performance in a product level, this allows us to cross-check if their financials, they're stating the proper level of provisions or the proper level of financial metrics that we are keen to work with.
And one question as well that I hear a lot on the investor side is how much of this is done by humans and people like yourself and the people in the team, and how much is done by our technology or underwriting kind of scoring system? What does that look like?
There's a fair point. So it's a mix, right? So for us to start, when we start the business and we start the credit methodology, it's all about our understanding, the human knowledge. Of course, we also back up with some public papers that we see in the industry. So Fitch released a paper specifically for the NBFI industry, give a very comprehensive methodology to analyze NBFIs. The leadership team, they have an extensive experience in the industry. And let's face it, many of the financial ratios, they are quite known. But this kind of expertise to go this extra mile to understand who is behind the wheel, who is the risk management team, where the regulators for those specific countries they are going. This is the human touch of things. But since we wanted to grow fast on a lean structure, we need to rely on technology. So when I'm saying to you that we are digesting thousands and sometimes millions of data points, we are not doing it using an Excel. We need to rely on coding, so we have an equipped team to do it. And so it's a balance. And of course, as we move forward with the business, the tech part of it is helping a lot because our goal, our learning, and we are able to adapt it and evolve our algorithms as well.
Yeah, we wouldn't be able to be such a lean team without it, for sure. And my last thought for the day of this conversation is that as an investor, when you go onto the Kilde platform, you can see that these deals have a rating, and typically they range between B to triple B. And our methodology follow the Fitch NBFI rating criteria. Can you talk us through this a little bit more? What does it mean that I'm seeing a B-rated borrower, for example, on the platform?
Fair enough. So first of all, I would like to highlight that this is a equivalent rating, right? So as we mentioned at the beginning of our conversation, many of those NBFI they are not public ratings. So this is a approximation based on our internal Kilde score. So at the end of the day, what is a rating, right? It's just a measurement of risk. So it's giving what is the probability of default over a certain period for that NBFI. So based on our historical data analysis of dozens and dozens of NBFIs and ratings, also a peer comparison. So we did our homework since we launched the business, and then this allow us to set up what is the expected probability of default of that company, and then we can match with the probability of default of Fitch rating. So that's how we peg both ratings. So as you well said, we are concentrating this niche of single Bs and double Bs, and we can see opportunities on the triple Bs because from a risk perspective, they're still solid companies. So if you go to a triple C, which is our scope, just for the sake of clarity, we are talking about over 20% risk of a bankruptcy case in the following 12 months. When you go to the single B, double B, this diminishes dramatically to lower than 3 to 1%, depending on the rating. So this gives you an understanding that the higher you go on the grade, the lower is the probability to default, and then our investors they are on a better shape, right, to invest in our platform. So yeah, so that's more or less our rationale.
And what about going up? Because one of the common
Oh yeah,
questions is
sorry.
right is that we have that what Gustavo said, triple C, which is out of our scope because it's too risky, and then you move into a single B and double B, triple B, and then above that you have a single A. So why do we not touch the single A NBFIs?
It's just a matter of having competitive use, right? The higher you go on the grade, the more access the NBFI will have to fund their loan book. So they have access to the capital markets, they have access to the big banks, even on a higher level of those, they're rated at B, double Bs, and even triple B is opportunistic to us. But there's a lot of room on the single Bs and double Bs to have steady returns under good risk levels. So it's all about competitions in terms of the yield that we are providing to our investors.
All right, and maybe fair to say then that the B segment needs us the most as well. That's where we add the most value in terms of funding.
So it's a journey, right? So we have quite a decent range of borrows in terms of size, jurisdictions, and even in rating. I think it's quite important for our investor base to be educated to diversify. And then, of course, enjoy higher yields with a lower grade and so on. But we like to work with all those players that they have a solid track record, good financials, good lending products, and they can go over this spectrum. So we don't have any kind of issues to work with the top tier guys as well, as long as we are delivering some value to them as well, and which is the case, okay? Because bear in mind that our platform, we can be an alternative source of funding for them, right? So we don't need to be their primary source of funding. So even though maybe we are charging a higher yield, and sometimes it makes sense.
Okay, super. Thank you very much, Gustavo. That was very insightful. And keep up the good work of zero defaults and zero delinquencies.
We are
And
doing our best.
exactly. And if you, as an investor or listener, have any other questions for us, let us know. And I'm going to share them with Gustavo so we can do another episode and follow up. Thank you very much.
Thank you. Bye bye.